Welcome back to the Retirement Income and Strategy Podcast. I'm Tom Malarkey from Hive Retirement Planning. And on this episode, we're talking about Roth conversions and how they fit into a confident retirement plan. I get asked about Roth conversions all the time. They're everywhere. And sometimes the attention is deserved, and other times it creates pressure to act before the decision is really thought through. Because the difference between a smart Roth conversion and an expensive one usually isn't about understanding the rules. It's about understanding the various trade-offs. What are you paying and what are you really getting? Let's take a look at Roths. Let's start simple. A Roth conversion moves money from a pre-tax retirement account into a Roth IRA. You're choosing to pay the tax now instead of later. Traditional IRAs and 401ks give you a tax deduction up front. You defer paying the ordinary income tax until you take the money out later on in life. A Roth, however, works the opposite way. You pay the taxes first, and the qualified withdrawals later come out tax-free. When you convert some of your pre-tax money to a Roth, you're making a very intentional decision. You're giving up on that tax deferral in exchange for tax-free growth and more flexibility later. That's where both the cost and the value come from. Mechanically, this part is pretty straightforward. You decide how much to convert, and it can be a portion of the account or the entire balance. There's no annual limit. Money moves from your traditional retirement account into a Roth account. But here's where people underestimate the impact. Whatever you convert gets added to your taxable income for that year. So if you convert $100,000, in the eyes of the government, that's $100,000 of additional income you have to pay taxes on. And they will tax you at ordinary income rates. And the tax bill is due that year. You can't spread it out. One more important thing, since 2018, there's no undo button. If the market crashes after you convert, the tax bill doesn't change. Once it's done, the Roth conversion is final. So let's talk about the costs involved with a Roth conversion. First, the one we just mentioned is the tax bill. Depending on your bracket and your state, this can be a meaningful number. Roth conversions are not to be taken lightly. That's why conversions tend to work best when you can pay the tax with additional money that's outside of your retirement accounts. If you use some of the retirement funds to pay the tax, it reduces what can grow tax-free. And if you're under 59.5, penalties may apply. Now, here's a mistake I see all the time. Someone is too ambitious and converts too much in 1 year. That pushes income into a higher tax bracket, and suddenly part of the conversion is taxed at a higher rate than expected. The goal is often to fill up a lower tax bracket rather than jumping into the next one. Another cost that catches people off guard is Medicare. Higher income from Roth conversions can trigger IRMAA surcharges on Part B and Part D. And as an extra surprise, Medicare looks back 2 years. For example, let's say you're 63 and planning a Roth conversion. You convert that $100,000 this year. That conversion doesn't affect your Medicare premiums now because you're not on Medicare yet. But when you turn 65 and go on Medicare, Medicare looks back at your income from 2 years prior. So that conversion you did at 63, it shows up when you're 65, and now your Part B premium jumps from the standard amount to a higher IRMAA tier. For some people, that's a several $1,000 increase in annual premiums that they didn't see coming. It's not necessarily a reason not to convert, but it needs to be factored into the decision. Conversions can also increase how much of your Social Security is taxed and phase out certain deductions. And remember, once you make a conversion, there's no reversal. Let me give you a quick example I see with clients. A couple retires in their early 60s. There's no paycheck anymore. Social Security hasn't started yet. And there are no required minimum distributions yet, known as RMDs. On paper, their income looks low, but they have large pre-tax retirement accounts. This is a perfect opportunity for a Roth conversion. But what I often see is the temptation to convert a large amount all at once, just to get it done. But when we slow down and run the numbers, we realize that a series of smaller conversions over 5 or 6 years keeps them in a lower tax bracket. It avoids Medicare IRMAA surcharges, and it ends up costing less taxes overall. It was the same strategy, but the process was spread out over 5 or 6 years and provided a very different outcome. Now let's take a moment to talk about where Roth conversions can really help when they're done well. First, there's the tax-free growth. Once money's in a Roth IRA, future growth can come out tax-free if the rules are followed. For money that stays invested for a long time, that compounding can be powerful. Next is flexibility. Roth assets give you more control over your taxable income in retirement. You can use them in years when you want to stay below certain thresholds or manage Medicare premiums more intentionally, or smooth out taxes when other income spikes. And that flexibility often becomes really valuable in the later years of retirement. Another big benefit is there are no required minimum distributions for Roths. At some point in your 70s, pre-tax accounts force money out whether you need it or not. Roth IRAs do not. That allows the money to stay invested longer and gives you control over timing. Finally, for many families, there's an estate planning benefit. Roth IRAs can be more efficient for heirs, especially if they're already in higher tax brackets. So when do Roth conversions usually work best? A basic rule of thumb is when your current tax rate is lower than what you expect it to be in the future. There's a common window for where this happens. After you stop working, before Social Security starts, and before RMDs begin. Many retirees have a 5 to 10 year stretch where their income is unusually low. That's often the best opportunity for partial Roth conversions. Conversions can also make sense in years with lower income, large deductions, or a big market decline. This isn't about whether Roth conversions are good or bad in theory. It's about timing and how it fits your specific situation. A few rules about Roth conversions to be aware of. Each conversion has its own 5-year clock. If you withdraw converted funds before age 59 and a half and before 5 years have passed, penalties can apply. For most retirees, this is only a planning detail, but it does matter. If you're already taking required minimum distributions, the RMDs must come out first. Only money above the RMD can move into a Roth. And state taxes matter. If your state has an income tax, conversions are usually taxable at the state level too. Be sure to include the state tax impact when running your numbers. One last point that's important. Roth conversions are rarely all or nothing. Most effective strategies involve smaller conversions over several years, filling up brackets, avoiding surprises, adjusting as life changes. Don't swing for the fences. I also encourage married couples to think ahead. Married filing jointly comes with wider tax brackets, but after one spouse passes away, the survivor often faces higher taxes on the same income. Planning your Roth conversions earlier in life can sometimes help manage that shift. The goal isn't to eliminate taxes, it's to create more control and more predictability. A Roth conversion isn't a shortcut, and it isn't a guarantee. It's a calculated exchange. Taxes paid today for flexibility and tax-free income tomorrow. When the cost is reasonable and the long-term value is clear, it can strengthen a retirement plan. When done without coordination, it can simply generate unnecessary taxes. The real question isn't whether Roth conversions are good or bad. It's whether it makes sense for you now, given your full financial picture. Thanks for listening. I'll see you next time.